Thank you so much for joining. Today I would like to give you an overview about cash flows. There are many cash flow measures out there, and sometimes it causes a lot of confusion about what to use, what are the different cash flow metrics that we have. So I go through, provide you some perspectives on the differences and which ones to use for certain applications. So first, EBITDA. EBITDA is purely from an income statement perspective. Is not a real cash flow number. As you know, EBITDA equals revenue minus cost of goods sold minus SG&A. EBITDA has nothing to do with cash really, but sometimes you hear something like KKR or another PE firm bought a company for, let's say, 12 times EBITDA. So you hear this one, especially in private equity, a lot. We use this as an approximation for cash flow. It's an easy way to say, okay, let's use EBITDA 6 times, 7 times, 10 times, 12 times, then we know about the performance. We get an idea how expensive the deal was. Why are we using EBITDA for this purpose and not EBIT, not revenue, not net income? You could also say KKR bought company B 7 times net income. We use EBITDA because if you look at the income statement, revenue minus COGS minus SG&A, EBITDA minus depreciation and amortization, EBIT minus interest minus taxes equals net income. So we are taking this number here and do a kind of approximation, because up to here, this gives you an indication whether the business model works. And here there are no accounting effects. It's purely operational. So this is basically in finance, this is your operational performance. Everything here has something to do with accounting structures, depends on your depreciation method. Is it straight line? Depends on which assets you expense, which you capitalize. It has something to do with your capital structure and so on here, tax impact. So here there are some accounting measures and principles involved that makes it really hard to compare, and second, company would have a certain chance to manipulate or to change certain numbers. So that's why we use EBITDA as a starting point or as an approximation for cash flows quite often. Yeah, that's why whenever you see EBITDA, it's not a real cash flow metric because it's still accrual accounting. It is not adjusted for non-cash items and so on, but it is used because it makes it easy to compare companies, industries, because those accounting effects, financial effects are excluded. Then when we look at cash flows from operations, this is basically the second one is from your CFO, which just starts with net income plus D&A because it's a non-cash item minus change in net working capital. And this is really cash flow from operating. Then an additional metric is called free cash flow, which you will find basically in your cash flow statement at the very end, which is basically your CFO minus CapEx. So you see this as well. However, those ones here, and I leave EBITDA out because EBITDA for me, it's an approximation of cash flow. 2 and 3 are for reporting purposes. So these are in your financial reports, cash flow statement, cash flow from operations, and some adjustments, especially CapEx, include adjustments as well from your investing activities, and then potentially you may do some financing activities as well. But this is all for reporting purposes. When we look at valuation, if you want to value a company, the approach is a bit different, slightly similar but also different. First, we have two measures. The first one is free cash flow to equity, and the second one is free cash flow to the firm. Here we really look from a perspective of capital providers. We look at equity providers here, how much money is available for us. We're not looking from a company perspective. And here, free cash flow to the firm, we are looking at from both perspectives, debt and equity holders, how much money is available for us. What we do for free cash flow to equity is similar. We start with net income. I explain you why in a moment. We add D&A, change in net working capital, and we deduct CapEx. And then if we change the capital structure, if we issue debt or if we repay debt, this has an effect on the equity providers, which we can, if we assume capital structure changes, there are some effects we can add those items. Otherwise, it's similar to the free cash flow formula we saw earlier. When we talk about free cash flow to the firm, we are not starting with net income, we are starting with EBIT. The reason is EBIT has not yet excluded interest payments. Interest payments are already payments to your debt holders. They already get rewarded via interest payments, which means if for free cash flow to the firm, if you would start with net income, then the formula would not be correct, because this free cash flow to the firm, to both equity holders and debt holders, was already adjusted, and some of the debt holders were already paid via the interest item here. So that's why you need to start from an income statement perspective. You need to start a bit higher to include both. It's a bit misleading. We say free cash flow to firm, but you always, when you look at those metrics, you always look at from an investor perspective, debt holders and equity holders. And then you do the same. Very important, the cash flows we are talking about when valuing are incremental cash flows at a particular moment in time that are available free, that's why we call it free cash flows, to pay the firm's capital providers, equity and debt investors. Here it's only the equity investors. For free cash flow to the firm, it's both. Makes sense if you value a project and the company makes cash flows of, let's say, 500 and the project makes cash flows of 200, then to value the project, you would only look at the 200. You would not do 500 plus 200 and look at 700, because you only look at the incremental cash flow that the project generates, because the other cash flows that are somewhere out there are not because of the project. Many of you may ask, but what about if I analyze a company and not projects? Then again, no company versus a company. So all the cash flows that the company generates are then from this perspective incremental cash flows, because if the company would not exist, you have zero cash flows. If the company exists, then you have all your cash flows, which is incremental. If you look at projects, then you really look at the impact of the project cash flows. Cash flows in a typical project, what do we have? Initial outlay, purchasing equipment, initial development cost, increase in net working capital. You need to buy raw material for production first. Ongoing cash flow, we have incremental revenue. Hopefully we sell some products. We may have incremental cost. If we do something new, there are some costs involved. We need to pay taxes, and maybe we need to change our net working capital, or the capital change in, or the net working capital is adjusted. And then terminal cash flows are the cash flows at the very end. Once, for example, the project is over, then you can sell your equipment. Maybe you can shut down some production lines that are used for this project. And then you can basically sell or decrease your net working capital, your inventory, and sell it without buying new inventory because you know the project is coming to an end. Very important. One thing is, and I would propose you mainly use this formula here because it's a bit easier to use because you don't have this interest tax effect. So you start with EBIT, use free cash flow to the firm, and your discount rate, if you use those cash flows, would be weighted average cost of capital. Yeah, that's your cost of capital as an average for both capital providers. If you use free cash flow to equity, your discount rate would not be WACC, would be cost of equity only, because these are the cash flows that are only available for equity holders because debt holders have already been paid. Why that? If we look at EBIT, or again, if we look at the income statement, revenue, cost of goods sold, SG&A, then you have EBITDA, that's the formula we had earlier, minus D&A, then you have EBIT minus interest. That's why interest is tax deductible, comes before, and then net income. So very important, we start with EBIT. That's a good starting point to start with EBIT. If you start lower, if you would start with net income, then the problem is your debt holders have been partially paid already here. So you need to start somewhere above, a bit higher. If you start with revenue, this doesn't make sense because you can't use revenue as an approximation because you need to pay your suppliers, you need to pay your employees, you need to pay your other costs to run the company. So this is definitely too high level. But if you go down a bit, it's good to use EBIT as a starting point. Then you deduct taxes because taxes are paid to the government, which means the EBIT number, if you use this one, is not available for debt and equity holders because you need to pay the government. That's what we do with this step. You say, okay, let's take out the portion that we need to pay to the government. And then we have a good figure, EBIT 1 minus T. T is the tax rate. It's not the tax expense, very important. So it's 20%, 30%, 40%. But then we need to do certain adjustments because EBIT is, again, not clean enough. It's not clean enough because EBIT is too low. We have more cash available because we have deducted D&A, which is a non-cash item. So we need to add D&A back. Plus D&A because we have deducted this, but it's a non-cash item, so we still have more money in the bank and would be able to pay our debt holders and equity holders with actually more money. So we need to do this. Then we need to do a net working capital adjustment, and net working capital adjustment is nothing else than basically looking at those items here in particular and looking at revenue and COGS and see, okay, not everything has been paid in cash. There are some credit payments. So especially here, accounts receivables, especially here, inventory accounts payables. Those items are not clean. They are under accrual accounting. They have been recognized under the income statement, but it doesn't mean if you have received 100 in revenue from your customer, it does not mean that you have actually 100 cash in your bank. Yeah, because it can be that you receive money later. Same applies for cost of goods sold and the inventory and accounts payables, because you may pay your suppliers later. Yeah, so you do those net working capital adjustments here to clean up those items. SG&A is mainly periodically, so it's not too critical, whereas revenue and cost of goods sold, there is a big timing difference between when it's recorded and when cash is received. SG&A, net working capital we did, D&A we did, and the last one is basically CapEx. And here the reason is, especially those big investments that you have, they do not fly through the income statement. So there are a few items that reduce your cash balance, reduce your free cash flow, but you can't find them on your income statement because they are recorded directly on the balance sheet. You see them in your cash flow from investing activities. So that's why we do those adjustments, and then what we basically get is free cash flow to both equity and debt holders. Yeah, and again, looks similar, but what we are not doing whenever we do valuation, we are constructing and calculating those numbers ourselves. We are not taking statutory reporting figures from the cash flow statement. We are doing those ourselves because there are some additional adjustments we need to do. So that's why sometimes the formulas may seem similar, but what we do is we calculate free cash flow to the firm or free cash flow to equity holders. And again, PE, many times EBITDA is used as an approximation. Yeah? Good. Thank you so much for listening. I hope you found this useful. See you in another video. Bye-bye.